Welcome back to the Deep Dive. Today, we're going straight into the Q3 2025 earnings call from New Holdings Ltd. That's ticker NU.
Right. And this call was a big one. You know, with all the volatility in fintech, the market was really looking for proof.
Proof that the story still holds up.
Exactly. Can this high-growth engine keep running, especially with higher rates in the region?
And what they delivered was, it was more than just a beat. The big takeaway for me is that New is a different kind of company now.
How so?
It's not just about growth anymore. It's a profit machine, a structurally advantaged one, delivering a 31% return on equity?
31%. And it's all being powered by this proprietary AI system it's changing their entire cost base.
Okay, so that's our mission today, right? We need to unpack the key numbers, dig into that AI engine they call the new former, and then look at the big strategic moves.
The U.S. bank charter filing and that new Amazon partnership. Huge potential catalysts. So let's start with the scorecard.
Yeah, give us the highlights. What did the market see right after the bell?
Okay, so the top line numbers were really strong. They reported Q3 earnings per share of 17 cents.
17 cents. And
Right.
consensus was what, 15?
15, yep. So a nice 13% beat. Revenue came in at $4.17 billion.
Which is well above the 4.03 billion estimate. That's nearly 42% year-over-year growth.
Just massive numbers. But you said it earlier, the real story here is profitability.
It has to be. Adjusted net income hit $829 million. And that record, 31% ROE, you just don't see that.
You don't. Not when you're scaling past 127 million customers. It's rare air for any company, let alone a fintech.
So here's the thing that's interesting to me. With all that, the stock barely moved. It was up, 1.5% the next day?
Yeah, and I think that tells you something important. This call wasn't a huge surprise that changed the whole story.
It was a confirmation.
A powerful confirmation. The market already expects this level of excellence. The bullish case of high growth and high profit is just completely intact.
All right, so if the market already expects it, let's get into the weeds. Let's talk about the architecture that makes that excellence possible.
It all starts with scale and efficiency. They hit 127 million customers, added over 4 million in just the quarter.
But the key metric isn't just the raw number of customers, right? It's the activity rate.
It is, and that's holding steady above 83%. That's an incredibly sticky platform.
And that high activity is what fuels the whole monetization engine.
Exactly. It pushed their average revenue per active customer, or ARPAC, up to $13.40.
$13.40. That's up 20% year over year on an FX neutral basis. So you can see how each customer is becoming more and more valuable.
They are, but here's the part that is it's hard to wrap your head around.
Yeah.
Their cost to serve an active customer.
It's 90 cents.
90 cents. It stayed stable at just 90 cents.
It's wild. You compare that to a legacy bank in the US or Europe spending, hundreds of dollars per customer, and you see the structural advantage right there.
It's everything. It's why their efficiency ratio, so their cost to income, just keeps falling. It's now at 27.7%.
An unbelievable number. And that operating leverage is what lets them reinvest so heavily and still post that 31% ROE.
So let's look at the balance sheet. The credit portfolio grew 42% year over year, $30.4 billion.
But it's not just growth for growth's sake. They're changing the mix.
They're diversifying. Secured and unsecured loans are now almost 35% of the total balances. That's a deliberate shift towards safer, lower risk assets.
Okay, so that brings us to margins. And this is where it gets a little more complex. The headline net interest margin, or NIM, actually compressed a bit.
Right. It dropped about 100 basis points to 17.3%.
So why would the margin look softer when everything else is so efficient?
Well, it was really two things. First, that mix shift. When you move to lower risk secured assets, you naturally get a lower nominal yield.
Okay, that makes sense.
And second, their funding costs in Brazil actually went up. Management was very clear. They aggressively went after higher rate deposits from certain customers to lock in those primary banking relationships.
So they chose to spend more to get stickier customers and move to lower yield assets. On paper, that sounds like a bad trade.
It sounds like it, but it's at a trade of nominal yield for profit quality. And here is the absolute key takeaway on this.
Risk-adjusted NIM.
Your risk-adjusted NIM. When you account for the lower cost of risk, it actually expanded to 9.9%.
Okay, so unpack that for us. What does that expansion really tell you?
It tells you they're making much safer money. Risk-adjusted NIM basically subtracts the cost of defaults from the yield.
Right.
The fact that it went up means the money they're making per loan after you account for potential losses is better than it was before.
So they're trading a little bit of yield for a lot more certainty.
Exactly. And that is a very mature move. It's all driven by that AI advantage we're about to get to. Better underwriting, better collections.
Let's connect this back to the geographic strategy then. Brazil is obviously the core, the cash cow.
Oh, absolutely. They serve over 60% of the adult population there. The game in Brazil is no longer about getting new customers. It's about depth.
Deepening that wallet share.
Yeah.
Cross-selling.
Exactly. Making each of those 70+ million customers more valuable.
So the growth story really depends on Mexico and Colombia now.
It does. And Mexico is the one to watch. It's their fastest growing market. And this is where the investment thesis gets really interesting.
They passed 13 million customers there, right?
Yep. Reaching about 14% of the adult population. And the unit economics are proving out. ARPAC is already $12.50 in Mexico.
$12.50. So it's already almost at the same level as Brazil?
Almost. And management said, look, this segment has the scale to be profitable right now if we wanted it to be.
But they don't.
They're deliberately reinvesting every single dollar back into growth.
That's the tightrope walk for investors, isn't it? You love the long-term vision, but you're sacrificing profit today.
You are. They are choosing market leadership tomorrow over profit today.
Right.
And then you have Colombia, which is smaller, approaching 4 million customers. That's more of a long-term call option for them.
Okay, let's pivot to what they called their core strategic theme on the call. This move to an AI-first platform.
Yes. This wasn't just, we use AI. They were very explicit. AI is their new operating system.
And this is where they talked about their proprietary foundation model, the new former.
Right. And the scale is just immense. They threw out some huge numbers.
330 million parameters, trained on 600 billion tokens. What does that actually mean in plain English?
So think of parameters as the model's capacity to understand complexity, and the 600 billion tokens. That's the data.
Every transaction, every risk score.
Everything. It's a massive proprietary data set that gives them a huge predictive edge. It's why they can claim these models deliver an average improvement that is 3 times higher than a typical machine learning upgrade.
3 times higher. That's a bold claim. Did they give a concrete example of what that does for the business right now?
They did. Credit card limits in Brazil. The AI allowed them to significantly increase credit limits for a whole group of customers.
Driving more revenue.
Right. But here's the key part. They did it while maintaining the exact same risk profile. The AI found revenue that a human or a simpler model would have been too scared to unlock.
That's a powerful proof point. So beyond the AI, they also highlighted 2 new catalysts. The first one feels huge. Filing for a U.S. national bank charter.
It's massive. And they were clear, this isn't about opening branches next year. This is a multi-year plan to position Nu as a global digital bank.
It's a statement of confidence, really, that their tech and their cost model can compete anywhere on Earth.
It is. And the second catalyst was the Amazon Brazil partnership.
Right, integrating NuPay for installment plans.
Yep, up to 24 months. This should be a nice boost to purchase volumes and fee income. And crucially, it's another stream of high-quality data to feed back into that AI model.
So bringing it all together, NuPay is it's in a different league than its peers, right?
Yeah.
Growing at 40% with a 31% ROE.
It's just a massive outperformance. In terms of guidance, they didn't give any hard numbers.
No EPS or revenue targets.
No, but the qualitative guidance was very clear. Maintain ROE above 30%, keep pushing that efficiency ratio down, and keep investing aggressively in Mexico and AI.
And what about the regulatory side? What headwinds are they watching?
Well, the U.S. charter is a long, expensive road, and in Mexico, there's a proposed cap on interchange fees.
Which they're pushing back on.
They are. They're arguing it would actually hurt financial inclusion by making it harder to offer credit to new customers. So that's something to watch.
Okay. This brings us to our This Is Not Financial Advices segment. Time for an outrageous but plausible trade idea based on all this.
All right, hear me out. The thesis is aggressive. You go long in U, and you short a basket of U.S. regional banks. Or maybe a lagging U.S. fintech index.
Okay, that's definitely aggressive. You're betting Nu can take its model into the U.S., which is a whole different beast, right?
Yeah.
The regulation, the compliance costs.
It's speculative, I know, but that's the whole angle. The market is valuing NU on its latent growth story. It has not priced in the possibility of it becoming a true global AI native platform.
So the bet is on efficiency arbitrage.
Exactly. You're betting that their tech stack, that sub $1 cost to serve, is transferable. You're betting that their AI, which they claim is 3 times better, can just dismantle the high cost structure of U.S. banking.
And if they can bring a 27% efficiency ratio into the U.S. market.
It would create immense pressure on the incumbents, so you capture that value by shorting the old guard. The catalyst is any early positive news on that U.S. charter, combined with them continuing to lower their efficiency ratio even further.
It's a bet that software truly is eating the world of finance. A fascinating idea.
And that's really the summary of this whole deep dive, isn't it? You have record profits, you have AI as the core operating system, and you have this aggressive, deliberate scaling in their next big market.
Which leaves me with one final provocative thought for you to think about. Nice is explicitly sacrificing profit in Mexico for long-term dominance. That strategy requires a lot of patience from the market. So the question is, how long will investors give them before they start demanding to see bottom-line results from Mexico?
That is the multi-billion-dollar question, isn't it? Thank you for joining us for this deep dive. We hope this gave you a clear shortcut to what really matters from the call.
And as always, this discussion is for informational purposes only. It's not a solicitation to buy or sell any securities. Please do your own research. We'll see you next time.